Welcome to the Federal Retirement Podcast. My name is David Raetz from Benchmark Financial Group, and every month we discuss important topics regarding the retirement planning process for federal employees. This Lunch and Learn series is an interactive discussion where individuals can ask questions. To join these discussions live, you can register by joining our email list at bfgkc.com. Additionally, if you're looking for assistance to get your retirement on the right track, set up an appointment with us today. You can schedule an appointment online by visiting our website, bfgkc.com, or email me directly at david.raetz@bfgkc.com. The contact information is also listed in the description. By setting up a complimentary consultation, we can review your financial situation and develop a plan to meet your financial goals. We hope you enjoy this topic and hope to connect with you soon.
Welcome to Benchmark's Lunch and Learn. My name is Patty Riley. I assist Gary and David Raetz. For those of you that are new to our Lunch and Learn, we do this once a month, typically the third Thursday. Today, our topic is retirement. Do you have questions? And we do welcome questions. Feel free to unmute and ask or type them in the chat box. With that, I will now turn it over to Gary.
Hi. Thanks, Patty. My name's Gary Raetz, as founder and president of past president of Benchmark Financial Group, Kansas City. I'm going to introduce today's speaker and current president, David Raetz. David will be presenting our webinar, Retirement. Do you have questions? This will be a great program and also the opportunity for each of you to ask questions you have about retirement. Please ask any questions you may have, or you can call and set up an appointment to meet with us and discuss your specific concerns and questions about your retirement. David, I'm turning the program over to you.
All righty. Well, thanks. Like we were saying earlier, thanks for tuning in to the call, everyone. This month's topic, we thought it would be prudent to just touch on some of the main, 1,000-foot up view, some of the main questions that a lot of retirement conversations tend to center around. So that's why we went with retirement. Do you have questions topic? So again, feel free to chime in with anything that comes to mind, and we'll go from there. All righty. So this one is just the same disclaimer that we always have in the information that we're presenting. In a nutshell, we're securities licensed. So what we're saying with this slide is that we're trying to be as accurate as possible with the information that we're sharing with you guys. So, all righty. Am I eligible to retire? So it's important to keep in mind that the three main sources of retirement income for a federal employee that's looking to piece the puzzle pieces together into a plan that makes coherent sense. So you got your first main leg is your first pension. Second main leg would be your first supplement or Social Security, depending on when you decide to retire relative to age and years of service. And then the third main piece of the pie would be your thrift savings plan, TSP. And I always say, so the pension is fairly mechanized. The supplement or Social Security is fairly mechanized too, where you have a lot of flexibility and freedom with what you do is what you'd hypothetically do with the TSP funds that you've been saving for all these years. So, all righty, when it comes to the pension piece of things, it's important to know what your minimum retirement age is. So for a lot of folks, that tends to be 56. So it hinges on your birthday. So if you were born from 1953 to 1964, MRA, what they call minimum retirement age, is 56. And it's important because it ties into when you can hypothetically retire. So when we're talking about requirements for an unreduced first pension annuity, there's three main milestones of age and years of service that you want to keep in mind for what they call the unreduced first pension. So you got minimum retirement age with 30 years of service. That one you got to hire on pretty early on to get to 56 with 30 years of service. So where we see a lot of folks drift into is deciding between whether or not they want to retire at age 60 with at least 20 years of service or at age 62. So again, the three main bullet points: MRA with 30 years of service, age 60 with at least 20 years of service, and age 62 with at least 5 years of service. If you hit one of those three, your calculation factor is 1% times high 3 times years of service. But if you decide to retire at age 62 with 20 or more years of service, you qualify for what they call the full unreduced first pension. So if you're in that full unreduced first pension boat, then your calculation factor is 1.1 times high 3 times years of service. So in a nutshell, it's if you retired 62 with 20 or more years of service, it's a 10% increase in your pension calculation relative to like 60, 61 or any of those other bullet points. So it's important to keep in mind that there is a difference between your unreduced and your full unreduced first pension. And in addition to that, so if you were hired on before 2013, 0.8% of your base pay goes to the FERS retirement coffers, and then 6.2 goes to Social Security. But it's important to take note of the fact that they've addressed this funding gap that exists or that takes place with a lot of pension plans. So new people that they've hired on have been in a position where they contribute significantly more. So if you were hired on after January 1st of 2013, you're contributing 9.3%. If you're hired on after January 1st of 2014, your cumulative total of FERS retirement contributions and Social Security contributions are 10.6%. So 4.4% for people hired 2014 plus is what they put into the FERS retirement system coffers, and then 6.2 goes into Social Security. So it's important to keep in mind that it ties directly into the viability of the plan. The fact that they're addressing that new hires are contributing more than people who were hired on pre 2013. So this also kind of ties into a lot of times folks are speculating on, changes they'll make to the benefits. And, a lot of times you hear rumblings about them switching from like high 3 to high 5. There's kind of a laundry list of them that get kicked around, but typically what we've seen over the years is that they don't necessarily make changes, and you never say never, but they don't really make changes to people that have been in the system for decades. What they do is they make changes to the new hires that they're bringing on. So you never say never, like I was saying a second ago, but realistically, a lot of the changes in the benefits get applied to new people that they're hiring on, not folks that are knocking at the door of retirement, so to speak. So, all righty, do you have enough money to retire? So, again, we're touching on switching gears and looking at TSP here for a second. So contribution amounts, you can put in a percent of salary or a flat amount each pay period. Usually if you're trying to max out the contributions, that's going to be a flat amount that you put in each biweekly pay period. And you can go on TSP's website and they have a nifty little calculator where you can pull up like relative to how many pay periods you are into the year. You can figure out, what that exact dollar amount is that you need to put in each pay period to get to the max. So for 2023, the max total deferral limit for TSP is $30,000. So you get the base regular contribution amount, which is $22,500 for 2023. And then if you're over the age of 50, they let you do this additional catch-up contribution, and that allows you to squirrel away an extra $7,500, which gets you to the $30,000 total. And that can be a combined total of Roth or traditional TSP contributions. So you do all of it into the traditional side, all of it into the Roth side, some of it into Roth, some of it into traditional. So, but it's important to keep in the back of your mind that your total amount that you can contribute between traditional and Roth is 22.5. If you're over the age of 50, then you can put in 30,000. So, all righty. So it's also good to have a refresher on the individual fund options, because a lot of times it can be like a set it and forget it approach, which you don't necessarily want to get in that boat. You don't want to be looking at it like every day, freaking out with stock and market variability. But at the same time, you also want to somewhat familiarize yourself with the fund options, because even if you're invested in life cycle funds, the L funds are comprised of G, F, C, S, and I anyways. It's like a pie chart that gets adjusted on a quarterly basis. So when it comes to the individual funds, so the two safest funds would be G and F. So government securities, which is short-term U.S. Treasuries, is definitely the safest out of all the funds. It's not going to blow the socks off of growth to the plus side, but it's also not going to go down when there's periods of volatility like we saw last year. F fund traditionally is considered a safe fund as well. It's fixed income, and that fund tracks the Bloomberg U.S. Aggregate Bond Index. So it's a mix of high quality and investment grade bonds, in addition to government securities. So FG would be the two safer options when it comes to TSP fund options. F is in a little bit of a tricky time because we're in this boat where the Federal Reserve keeps incrementally raising interest rates. So last year, that caused the value of your shares of F fund to go down each time the Fed incrementally bumped interest rates half a percentage point. It's not that F is a bad fund at all. It's just a byproduct of us being in the specific times that we're in when it comes to the stock market and Federal Reserve and a number of variables that are going on. So moving on from the safe funds, though, C fund is essentially the S&P 500 index. So we're looking at large and medium-sized stocks that comprise that index, and it's been around for a long time, and it's one of the major stock indexes that are out there. That's out there. S is what they call small cap stocks. So that one tracks the Dow Jones U.S. Completion Index. So it's got a lot of companies that don't necessarily fall into the C fund classification. So that's why they have separate S fund for smaller companies in the growth phase, so to speak. And then I is international stocks, and that tracks the MSCI index of Europe, Australia, and Far East. So GFCS and I, like we were talking about. All righty, TSP fund return. So one thing that I think is really important to keep in mind is that, so the S&P 500 is kind of like this benchmark index that's been around since like the late 1800s, and it's got lots of money tied to it in terms of a measuring stick, so to speak. So C fund, the square that's in the blue here, C fund has been around since 1988. And its average annual return since inception has been a little over 10.5% since 1988. And that's not to say it does 10.5% every year, and it's like a 45-degree angle up. But when you take into consideration, out of all the periods of growth / volatility that we've seen since 1988 till today, 10.5% has been the average annual return on C fund. So one of the things to keep in mind too is that if you don't make emotional decisions. That's one of the keys with TSP. Is one major thing you don't want to do is wait for market volatility to happen and then have your account value bottom out. Like you used last year as an example, if you freaked out and moved the money out of C into like G, for instance, when the market was at the low point, a lot of times when people do that, they're paralyzed trying to figure out when to buy back in. But if you're diligent about it and you keep being strategic and don't make emotional decisions, that's usually the name of the game right there. And when you think about it too, each biweekly paycheck, it's always a bit of a sting to see the balance of money that you have in the plan go down. But each biweekly paycheck, if you're invested in C with your contributions, you're buying shares as the market's going down too. So you're kind of like auto dollar cost averaging in that sense. So just an important bullet point to keep in the back of your mind. All righty, so TSP individual fund returns for year-to-date 2023. G funds sitting at a little just shy of 1% to the plus side. F funds a little over 3% to the plus side. C funds about 7.5% to the plus side. S just shy of 6% to the plus side, and then I is a little over 8.5% to the plus side, which is a little bit different than like what we saw last year, where G was the best performing fund across the board. F fund was down about as much as C fund, and S fund and I fund were also down 20% and 13%. So, all righty. So TSP life cycle funds. Life cycle funds are a fantastic option for a lot of folks. It's just important to know the inner workings of how they work. So, like we said earlier, every life cycle fund is a mix. It's a pie chart of G, F, C, S, and I, and the selection is based off of when you plan to start withdrawals. So The L2065 fund has a lot more variability than the L2025 fund, for instance, or L income fund. And those holdings, that pie chart gets adjusted quarterly. So the closer and closer you get to that date, it gets more and more conservative. So like we said a second ago, 2065 is designed for younger participants. It's going to have greater price variability than L2025 or L income, but it's also going to have more growth potential over the long haul than L2025 or L income. So just a little snapshot into the life cycle funds and how they work. This one is just a breakdown of sometimes a lot of people tend to gravitate towards L2030 for a number of different reasons. So this would be a snapshot of the distribution for L2030 for April 2023. So like we were saying, for April 2023, L2030's got about 34% in G fund, 6% in F fund, 31% in C fund, 8% in S fund. So, and then year to date, it's up about 5%. So just a little snapshot into the breakdown of one specific fund here. And like we were saying a little bit ago, it's important to keep in mind too, that the balance of money that you have in the plan does not have to be invested the exact same as your contributions into the plan. So sometimes when people are getting closer and closer and closer to the door of retirement, or they're kicking around different retirement dates and they think it might, it's in the near future, hypothetically, your account balance doesn't necessarily have to be invested the exact same as your future contributions. So a lot of times people will park, when they're getting closer to retirement, they'll park a larger percentage of money that they have in their TSP plan in G fund, for instance, and then keep their contributions invested in C fund, hypothetically. So if the market goes down, right, as you're looking to retire, the balance is protected in the safest fund, but each biweekly paycheck, you're buying shares of C fund, hypothetically, at lower and lower market price. So like last year, if you had employed this strategy, it would have been a pretty good way to do it, because you would have had the balance of money in the plan invested in the fund that generated the best return out of all the options. But each biweekly paycheck, you would have been buying shares of C fund as the market was incrementally going down over the course of 12 months out of the year. So another little tool to keep in the back of your mind. All right, so the other third piece of when we're talking about that 1,000-foot up view, the third piece of the pie, or one of the main legs of the retirement pie, is the FERS supplement, in addition to Social Security. So if you're in a boat where you're looking at getting the FERS supplemental piece, that means you're eligible to retire from the federal government, but you're not eligible to turn on Social Security. So if you fall into that category, Uncle Sam pays you this nice little bridge payment that it's designed to mirror Social Security, but it gets paid by the Office of Personnel Management. So that if you're getting that supplemental payment, it comes from OPM, not Social Security, but it works pretty much the same as Social Security in a lot of respects. So if you fall into that category where you can retire at minimum retirement age with 30 years of service, or age 60 with 20 years of service, that's when you'd be eligible for the FERS supplement. And the formula for how you arrive at the amount is your Social Security amount times your years of FERS service divided by 40. So that, in a nutshell, means that the more years of FERS service that you have under your belt when you retire, if you're in a spot where you can get the FERS supplement, the closer that payment's going to be to your age 62 Social Security amount. So always important to keep in mind that supplemental piece of things. How about Social Security? All righty. So even with Social Security and the FERS supplement, if you turn on Social Security between age 62 when you're first eligible and your full retirement age, there's an earnings test that's applied. So in a nutshell, they don't let you turn it on what they call early and then go make an unlimited amount of income. So Non-work income, though, does not count against the earnings test. So non-work income would be defined as your government benefits. So that'd be like your first pension, investment earnings, interest, pensions, annuities, capital gains. All those income streams don't count against the earnings test. And self-employed income counts when you receive it, not when you earn it. So the earnings test amount for 2023 is $21,240. That'd be like the amount of W-2 income that you could go make without having to worry about the supplemental piece getting reduced or Social Security. So, all righty. If you haven't taken a look at a Social Security statement in a while, it's worthwhile taking a look at it, because the big bold number that they put on the front of the page isn't necessarily the payment that you're gonna get. So the big bold number they put on the front of the page is your full retirement age payment, but you're first eligible to turn Social Security on at age 62. So in this hypothetical example, the big bold number on the front of the page would have been the age 67 benefit, not necessarily the benefit that's payable when you're first eligible to start, which is age 62. And that full retirement age, it's a byproduct of when the year you were born. So it just depends on you. That one's pretty easy to figure out. You can pull this one up and from a number of different sources. But if you're born 1960 and later, your full retirement age is 67. So, all righty. So there's a lot of debate that tends to take place around when should you turn on Social Security? And I would say in a nutshell, we tend to gravitate towards turning it on sooner as opposed to later. So one thing to keep in mind is that Social Security is it's a monthly benefit that's payable while you're alive and well. It's not necessarily an asset. It's not like TSP where it has a cash balance tied to it. It's a monthly payment that gets paid to you while you're alive and well. And really how you win with Social Security is by living a long and happy and healthy retirement and squeezing as much money out of the plan as you can. So one thing to keep in mind too with Social Security is $1 in hand a day is worth more than $2 at some point in the future. So it could take years to make up the income that you lost if you defer distributions past full retirement age. And it can provide a needed source of income that increases your net monthly income relative to when you want to retire. So sometimes folks are like adamant about, they see this age 70 number, which is the biggest payment amount, and they're adamant that they have to retire, or they have to wait until like maximum age possible to max out that benefit. But it's important to keep in mind that Uncle Sam's already squirreled away this pot of money that they plan to pay you as a Social Security recipient. So the reason that the age 70 number is higher is because you're getting a shorter duration of payments out of this pool of cash that Uncle Sam has set aside for your benefit. So if you turn it on at 70 as opposed to 62, you just waived 8 years of monthly payments to get to that higher amount. So then you're always talking about the debate of, well, God forbid if you keel over and die at age 71, you would have paid in all this money, you would have gotten 1 year of benefit payments, and Uncle Sam wins. So on the flip side, though, one of the major reasons that people tend to defer taking Social Security is if they're working relative to when the full retirement age hits. So you can't go make an unlimited amount of money between 62 and whatever your full retirement age is. So, but there's no limitation on what you can make after you turn. If you, let's say your full retirement age is 67, you can turn Social Security on to 67, they don't care what you're making. So you can make an unlimited amount of money if you turn it on past full retirement age. All righty. What health benefits will I have in retirement? So FEHB in retirement, some of the main bullet points to keep in mind is that you, the employee, must be insured at the point of retirement. You must have been enrolled or covered as a family member for 5 years preceding retirement or since the first opportunity to enroll. And the government treats CSRS and or FERS surviving spouses as an active employee. So This is a big deal because Uncle Sam subsidizes the FEHB premiums for the surviving spouse's lifetime. So if you're in a boat where you took either the partial or the maximum surviving spouse benefit, it's important to keep in mind that if you have a spouse, that they will be able to continue forward with the subsidized FEHB premiums for the remainder of their lifetime, which Uncle Sam pays about a little over 70% of the total cost of that FEHB premium. So it's a major piece of the pie when it comes to planning for retirement with federal benefits. This one, so when open season rolls around, or even leading up to open season, it's probably worthwhile just to shop the different plans, because health insurance plans are always changing and evolving. And there's a nifty little tool on OPM's website. If you go to opm.gov and then you go to insurance tab, healthcare plan information, and compare plans, it lets you pull up, I want to say, like 6 different plans by your zip code. So, and it's important to shop them by your zip code, because a plan that might be competitive in one area of the country isn't necessarily the most competitive in another area of the country. So again, going back to that idea, or that reality that health insurance plans are always constantly changing and evolving from one year to the next, sometimes it's worthwhile to just pull it up periodically and see what the changes are in your backyard. And there's an easy tool to do that on OPM's website. So how do you know if you are financially healthy? All right. So one of the big things you can do is reach out to us. So our first meeting is always what we call a fact-finding meeting, where it's, in a nutshell, information gathering and sharing. So when we're setting up those fact-finding meetings, we always send you a list of identifying information to gather, if you can track it down, if possible. It's not necessarily like, a mandatory thing to track down every piece of information, but there's kind of some main identifying pieces of info that we try to get our hands on, because the more accurate the input information is that we have, the more accurate we can be with the plans we put together for you. So first meeting, like we said, fact-finding meeting. Second meeting, we put together a written plan for you, where we present your preliminary retirement plan. We call that one version 1. And it breaks down each piece of the pie of your federal benefits and puts together an income strategy for you of what you can do with TSP funds. And sometimes those morph into versions 2, 3, or 4 over the course of time, just depending on what people want to do and adjustments that they want to make. And then in subsequent meetings, the idea would be we set the income strategy into motion, open up the accounts, manage your funds on an ongoing basis, and make adjustments as life happens and as needed. So even after the point of retirement, it's an ongoing relationship with the people that we have as clients. So what documents and forms do I need to get started? This is an important one. All righty. So some of the main ones would be just a recent copy of a leave and earnings statement and LES. We like that one because we always run a net to net income comparison, which just breaks down, it flips your current income from biweekly to monthly, and then we compare that to your gross retirement income sources at the point of retirement, because it's important to see that a lot of the stuff that you pay for as an active employee goes away at the point of retirement. So oftentimes people are in the spot where the lion's share of their deductions as a retiree are taxes and FEHB premiums, maybe some FEGLI premiums for a finite window of time. But for the most part, a lot of times it can be scary, because they're looking at this gross income estimate on retirement estimate from HR, and it's a lot less than what their gross income is while they're actively employed, but they forget about all the stuff that's coming out of their paycheck while they're actively employed, which makes the net a lot closer than people think it is. So when you're not paying like Medicare tax anymore, no Social Security tax, no TSP contributions, it makes a big difference, and it's easy to forget about it, especially when you're comparing that to, well, what is my net monthly income going to look like as a retiree? So that leave and earning statement becomes an important piece of identifying information. And a copy of a retirement estimate or FERS benefit statement If you can't, if HR hasn't necessarily run a retirement estimate for you, the annual benefit statement has a lot of identifying info. Third piece would be just a recent TSP statement or just an account snapshot that just shows balance and the funds that you have invested in. Fourth bullet point would be any other investment statements that you've, or for accounts that you've been saving for retirement income along the way. And then detail on any life insurance policies, long-term care insurance policies that you have in force. Those are important to know as well. So, Social Security statement is an important one. Divorce decree, if that's a piece of the pie, you always want to just make sure you have all your ducks in a row with that piece of things. And then if you want to get, a lot of times people get to the point where they want to incorporate a spouse's benefits. So that would be the last piece of identifying information. So how about any questions?
There aren't any questions in the chat box. Gary and David, do you have anything else?
I would say just if you have any questions or you think of anything, don't hesitate to shoot me a call, or you can always send me an email at that email address, or just go to our website and you can set an appointment or drop a comment in on our website. So again, thanks for tuning in, and we hope to see you guys in the future.